Good day, and welcome to Donald Ransom's Weekly Wraps. I'm Viv Gounder, and as usual, what we'll do is we'll start up with some macroeconomic stories and end with a tech story at the end. Our macro stories this week are going to be the SA elections as well as the US inflation number that came out. In our tech segment, we'll discuss chips, particularly after Meta came out with a internally designed chipset. So, let's start with elections. A poll this week was released and considered to be quite, reasonably, serious, sort of frivolous one, showing that Jacob Zuma's MK party now appears to be said to be the third largest party in the next election. Look, we still, as I speak, got about 6.5 weeks to go to the next election, so it's quite a bit of time, but we are, not that far away. And the difference in terms of numbers from what this party was pulling in January to now, April, is significant. In January, we're looking at about 2%. Now we're looking closer to 12 to 13%. Jacob Zuma remains a very popular figure in KZN, where this party is primarily going to get its support from. He's, like I said, remains very popular. One has to recall the Durban riots that occurred a few years ago when he was arrested to show the kind of popular support he does have among the populace in KZN. And if you look at just some of the breakdowns of what happened here, so you look at the number of voters going to his party, 13%. You look at what's happening with the ANC, it looks to be about 37% at the current measure. So add the two of them together, that's a 50% allocation, maybe just short of 50%, in which case one or two small parties would get you over the mark. However, according to the latest poll, just to give you an idea what's happening, it's 37% ANC, 25% DA, 13% MK, which is Jacob Zuma, and then 11% EFF. And then you have these smaller parties, the guys that are going to put in 2%, 3% if they're very lucky, those kind of guys. So there is a bit of a gap. So there's an ANC, there's a gap to the DA, then the DA, there's a gap to the two EFF and MK, and there's a significant gap then afterwards to the very small parties. Now, if the ANC is at 37%, it's going to be very difficult to make a coalition of over 50% with parties that have, say, 1 or 2% of the vote. It's going to be far easier to get a thing done with either the EFF or the MK, because they both have a kind of philosophical coalition with the two, between the ANC and these parties. Obviously, both the EFF leader and the MK leader, Jacob Zuma, were formerly part of the ANC. In fact, I think Jacob Zuma still technically is a member of the ANC, which is kind of weird. But you add 11% to 37, you're getting 48. You add 13% to 37, you get basically 50. And making up from 48 to 50 or just under 50 to 50 is very easy with one or two small parties. Obviously, a deal with the DA would put them well over 50. It'd be almost a coalition government, like a consensus government. It would put them basically above 60% at the current polling, which would be quite significant. But I think the philosophical gap between the ANC and the DA is pretty large. So that is the current state of play in terms of the election. Like I said, 6-7 weeks to go, and also we are looking at a situation where we have a significant amount of uncertainty as to just what's happening, just because of the flow of what's happened in the last, I'd say, 3-4 months with the MK. It could be this particular poll had a very large margin of error. Maybe it was on a particular day when Jacob Zuma had done some really good politicking out there, and that was giving them a little extra boost or whatever. Or it could reflect an actual underlying trend. We don't know yet. We'll get some more polling as we get closer to the election. That'll give us more confirmation about these kind of numbers. But right now, what's happening is that we are seeing a significant pullback in terms of ANC support, and it tends to be going towards Jacob Zuma's MK party. Enough pullback that we are not going to be seeing the ANC able to make it up without making a deal with one of the three big parties. Let's just say this proves to be a temporary effect. I would suggest that unless the ANC gets above about, say, 44-45%, it's not going to be able to pull off a deal with the smaller parties to get a stable coalition government in play to get 50%. Technically, you can have a minority government, I think, with 40%, where the president comes from a 40% coalition, but they want a 50% probably, because that's kind of what we've been used to South Africa. Without the ANC getting at least 45 to 50%, 44-45%, they will not be able to get a coalition together. The small parties, they will need to do a deal with the bigger parties. and the bigger parties are going to come with demands. And these demands are probably going to be destabilizing for South Africa, quite frankly. One has to look at what's happened in these cities that have coalition governments with the ANC and the EFF, and they've not worked out well. Even the ANC, to some extent, and the DA have not been great, but the ANC and the EFF parties have not worked out well for the citizens of those cities. Corruption has gone up. We've seen, a fall down in terms of service delivery, etc. So yeah, that's the elections. The next thing we talk about is the the inflation announcement that came out this week. US CPI came in at 3.5%, expectations were 3.4%. Problem is that we want to get it closer to 2%. So not only is it above 2%, it's above 2% and it's rising. And it's been rising the last couple of months. Now, there's a new term I heard of the last little while, and I think maybe many of you guys have not heard it yet. I mean, everyone's heard of core inflation. Core inflation is inflation subtracting, food and fuel and that kind of stuff. The things that are considered to be very volatile and therefore will not be giving you a clear indication of what's really happening with inflation. Excluding those things gives you core inflation. Super core inflation is those things excluded plus excluding shelter, effectively rental income. Now, when you look at that particular measure of inflation, super core inflation, things look terrible, absolutely terrible. In the last year, as of March, so year on year from last year March to this year March, super core inflation is sitting at not 3.6% but 4.8%. Okay, now you look at the latest inflation number, it's about 0.4%, 0.4% for the last month. That's CPI. Times it by 12, you're getting to about almost 5%. Look at the super core inflation of the last 3 months, and you analyze that number, it's closer to 8%. It doesn't just argue that we are seeing inflation not fall in the US. We are seeing significant signs inflation is rising in the US. And why exactly this is happening? Well, look at the super core stuff we're talking about. A lot of things are services, of course, student shelter, driven by wages, which is an important factor here. And look at what's happening in wage agreements in the US over the last little while. Well, we just had California come out with a new law that increased the minimum wage for fast food workers to $20 an hour. $20 an hour at the current exchange rate is just about 350 rands, 360 rands an hour. So 360, 300, I think, is 70 rands an hour. That's what we're looking at. That's not a small amount of money. 370 rands an hour. Okay, you do that for an 8-hour shift. Okay, and we're talking somebody that's making close on 3,000 rands, a day. Times that by a 20-day work month, we're talking about a 60,000+ rand per month salary. And remember, this is not you could try to achieve this level of income. No. This is the minimum wage you'd go for working in the fast food sector. This is supposed to be the job that you would get in high school, in the weekends. Like working at McDonald's. This is like the kind of job we're talking about. This is not I'm getting a career, I'm getting 30 or 60,000 or 65,000 rand a month. No, this is I am getting a job just out of high school, or maybe when I'm still in high school, a part-time job, paying me 370, 380 rands per hour. Now, this is obviously an increase from the previous minimum wage, and this thing as well is, if you look back in 2016, when Bernie started running for election, he was talking about a $15 an hour minimum wage. This is 25% higher than that, or actually 33% higher than that, from 15 to 33% increase. That is just from where it was in 2016. This is a significant increase in terms of what the minimum wage demands were. And back in 2015-16, $15 was considered to be an extremely aggressive, increase. The people are talking about, job losses and so on. Now, why is that a problem? Because the youth unemployment rate now starts with a 3. This is a very low unemployment rate. So let's just look at what the situation in the US is right now. The US growth rate is high. In fact, it's probably at a level that people would consider to be higher than the sustainable long-term growth rate in the US. So it's growing at faster than a sustainable rate. The US unemployment rate is probably what is historically been considered to be very low, lower than a sustainable full employment rate. It's above full employment as the term goes. So there's too few people without a job. So if you want to start a business, it's going to be very difficult to find new workers. You're going to have to go and try and poach them other places, increasing wages. And the US inflation rate is above 2% and rising. Put these things together. This does not say you cut interest rates. In fact, this is, if you were looking at this objectively, according to historical standards and historical measures and so on, you would say this scenario says the next interest rate move is going to be a raise, not a cut. So that's just where we are. What this has done to the bond market is quite substantial. At the start of this year, we were looking at, by June, July, a 99% chance of a rate cut. We were looking at rate cuts already happening last month in March. We were looking at, say, between 4 and 6 cuts for this year. The Fed had been predicting 3 cuts. Right now, the core assumption is 2 cuts for this year. And, if you had to look at it, balancing between 1 and 3 is not that high. It's not 2 to 3. It's easily 1 to 2 as 2 to 3 cuts for this year. That's a significant pullback. In fact, I think the more recent stuff I've seen is more 1 to 2 versus, say, 2 to 3. That is a significant pullback in terms of what the expectations are. Now, what does this mean? Well, surprisingly for the stock market, not much. On the day of the news, we saw the stock market come down a little bit, but since then, that's been a big impact. And so this is something that I've been telling you guys for a couple of months now. We started this last rally when the market was expecting massive rate cuts, and that's when we started it in October, when interest rates peaked at around 5% for the US dollar 10-year yield, and it's come down and went down to as low as like 3.9. Now it's about 4.6, so it's almost closer to 5 than it is to the low. Okay, so it's almost more than halfway back to the high than it is the low. Yet stock markets have not changed their trajectory. The spark that was lit in October when we started seeing the rate cuts come through, or the expectations of rate cuts coming through rather, that spark has continued to push this market higher. The market's not falling, yet the expectations of rate cuts have pretty much diminished. And like I'm saying, I would probably put the chance of the next move being a rise. It's not a majority, but I would say it's at least 10%. There's at least a 10% chance that the next rate move in the US is an increase. If we get another number like this, another 2 numbers like this year, I would put that closer to 50%. Okay, and so we're not that far away from having the market totally change its mind. Now, it's possible that maybe taking away the possibility of cuts in a given period of time is not enough to make the market fall. But you switch over to interest rates rising again, and this market will come down significantly. Okay. And finally, like I said, in our tech segment, we're going to discuss AI, the AI stuff that we usually discuss, but from the point of chips. A couple of developments happened last week. Firstly, there was a new theoretical development about transistors, and it basically allowed us to look at 1 nanometer transistors. Nanometers is basically like a billionth of a meter. Okay, it's a very, very tiny measurement. At this level, you have having quantum effects. Quantum effects are the stuff that you have to worry about. Weird kind of things like Heisenberg's uncertainty principle and that kind of stuff. Things above my pay grade, quite frankly. But let's just say there's getting to a barrier in terms of what we can do in traditional physics. You have to go to quantum physics, which is a more complicated form of physics, and there's more uncertainty, there's more difficulty operating here. Anyway, new chipset, 1 nanometer. It does indicate that we are not going to hit a barrier in terms of making these chips in the next, say, 5+ years or so. We are going to still be able to get the kind of improvements from purely making them smaller, making them more efficient, etc. At least for a little while longer. I don't know how much further we can go beyond this, because at like 1 nanometer, you're almost at the size of a molecule, and at that point in time, it's very difficult to get smaller. Okay, so. But at least for the next few years, we are going to be able to continue the Moore's law, kind of pumping more chips onto the chipset. The next thing is that Meta comes out with a design of its own, chipset focused on AI. Meta, as many people may know, has about hundreds of thousands of NVIDIA GPUs for AI and other things, of course, and is one of the big purchasers of these GPUs. Right now, it appears that NVIDIA does not have a limitation on the amount of demand for its computer chips. If it produces, it will sell it. That's just the fact of the moment. And so many companies out there are trying to find ways around this. They're trying to find ways in order to basically get themselves kind of off the total dependence they have right now on NVIDIA. We've talked about Dojo from Tesla. Obviously, we have Meta coming out. Amazon, Apple, Microsoft, anyone with sufficient money is out there trying to develop their own chipset. Why? Because they are seeing an almost unlimited demand for compute going forward, and they want to have a supply that's not totally dependent on one company, which is right now NVIDIA. And that is something that I think is going to continue going forward. And it recalls an interview that Sam Altman recently did. He says that at the moment it seems that the constrained demand for, like in the future, is going to be compute. That means computer chips. Elon Musk says that after the computer chip demand is over, the next thing is going to be transformers. Not transformers like, the transformer algorithm that they're using for making these things, but transformers like the stuff that you see in your grid that basically changes, electricity current and so on. And the reason is quite simple, is that one of the things that AI is going to allow, it's going to allow things like robotics, it's going to allow things like self-driving cars, which is going to make electrical vehicles, electrical robots much, much more in demand. And when that happens, what you're going to need is more electricity. And that means your grid is going to be under a huge amount of stress, and then you're going to have to basically upgrade it dramatically. And we're talking about, like a 50% increase in capacity probably from here for, the developed world's grids, and probably more than that in the long term. And that is going to demand a huge amount of copper, a huge amount of transformers, and so on. And that is going to be the next step after the chip stuff is going to be done. But for right now, for the next couple of years at the very least, chips seem to be in, there's unlimited demand for it, and if you can produce it, you're going to be able to sell it. Okay, that's it for this week. Thanks for joining me, and I look forward to speaking to you guys again next week. Cheers.